Okay, the market finished a strong 8-week run from the Christmas Eve lows up till now. What a move! What a strong move! Is this it? How much have we established the bullish trend now? Right, 8 weeks doesn't make a trend, a long-term trend, but it certainly can start one. So is this the start of one? So we're going to break this down. We're going to take a look at some long-term indicators as well as some short-term indicators to see what we can expect coming out of options expiration, whether we should expect some recent trends to occur there, considering how bullish we were going into it. So we're going to break all that down as well as a new trend trade idea that we have in a formerly very popular stock that has been very beaten up, that may be on the precipice of starting a new trend. So let's go ahead and get started. Today is Friday, February the 15th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 here and with the market forecast indicator like we always do. And you can see we remain, in fact, we came within a smidgen, the near term line at 79.39. So we came within about 0.6 of a point of getting an overbought cluster. Again, remember the Russell did get an overbought cluster over here, but I mean just barely coming off of a few weeks of multiple oversold clusters in a row. That's a lot of oversold clusters in a row, to the point now where we have really significantly made a move over this next cycle. Over the 2-month cycle, we go from low to low, and this 2-month cycle we go from low to absolute high, essentially up to expiration. Now we had a good run into the last expiration too. We'll see. The recent trend is to have some weakness, even if it's sideways weakness coming out. The problem is the more we go up without any normal weakness, then sideways weakness won't be enough. So that's just something to keep in mind. Whenever we do get an intermediate term pullback, which brings the green line down. The green line is so strong up here at 96. So that's a long time to be up in this level. I mean, we were up kind of at this level before, but we weren't coming up off such steep lows. To come up off such steep lows here, to get up to such a strong intermediate posture, it's relatively rare for that to happen. Remember, very headline driven here, very headline driven here, and it's all very related to tax reform, or not tax reform, was tax reform last year, trade war, right? Trade resolutions and potential resolutions and government shutdowns and all that stuff that's been impacting things over here, and Fed policy, which was that last nail here, and the change in that Fed policy, which has produced a lot of the rally that we've had. So very strong bullish posture. You can see very close to a cluster as well in the Dow Jones. Look at that big jump and close higher right at the high point in Dow Jones, just barely off of 2600, just 15 points off of, is that 15? 25 points off of 2800. Look at the NASDAQ composite, really getting close to 7500 there, another really close to a cluster. And then our Russell 2000 furthest away from a cluster, but still a pretty decent move, getting close to that 1575, 1600 area, where its peaks were during the November and December, well, really the November jumps, the two rallies we had in the month of November before the December declines. So quite the move, second consecutive options expiration where we significantly move higher heading into options expiration, which kind of shows where the pain trade is right now. The pain trade remains for the market to be to the upside, which means there are still people who think, who think things will go down, myself included. But if I'm heavily bearish based on those expectations, then this is going to be a pain trade for me, right? If we are mixing in bullish and bearish trades like we have been, right? In fact, most of my trades during this whole time have been bullish. If you've noticed in these videos, despite the expectations for a pullback. So you notice that just because I think we might come down doesn't mean that I'm loading up on bearish trades in anticipation of that. It just means I manage my risk differently on any bullish trades than I do when I'm in bullish trends where I expect a 1 to 3 month return, and I'm in a normal bullish trend. And that's the big difference. Going back to the S&P 500, You can kind of see here with the cycles and everything here. Let me just add on some time here to the right. There we go. Alright, you can see now where these fans are. This is the fan that we broke through, and look how much we've already come off of after having broken up above that one without testing it. I mean, usually when you're coming off such steep lows, you retest at either the 50 to 62% fan. We didn't really test at either one of them. Briefly at the 50% retracement and the 62% fan, and then we broke out and broke through the 62% and moved higher. You can see now, you know, for us to pull back down to this 38% retracement of that rally, it would be an almost 6% drop. So that's going to be a pretty decent move if and when we ever get it. Because, you know, at some point you always get those Fibonacci retracements. Just down to the top of the retracement zone. Getting to the middle point into the retracement zone is where you got the 62% now crossing over the 38% retracement level. So that's kind of catching up to the what would be in red the 50% retracement of this rally. So, you know, to get down to that point, if that ever happened, to get down to that point, you can see that would be right in this area would be about a 7% drop. Now that would be over 8 days, and I'm going to venture to guess in the next 8 days you're not going to be sitting at 2578. So, and that's what that would suggest with the crossing of the Fibonacci fan and the retracement level. So more than likely we're not going to get down to there. At worst, we'll probably come down into this 2600, 2640, now 2611. You know, in this area where you have Fibonacci, and we could still move this higher. In fact, if I moved up this retracement level up to 2800, you know, if that's where we get up to, let's say get up a little bit more above it, come maybe even get like a fake out move with these highs, then you notice that 38% retracement would be lining up right with that, or the 50% line. So in opposite directions, but they're lining up on top of each other. The 50 down here is lining up with the 38%. So you can see where the significant levels of support will be if we were to continue higher to 2800 before we get the pullback, right? And we talked about that. There's such strong momentum. You know, it's a very, very, very fluffy move right now, and it's hard for fluffy moves to reverse until it has some kind of catalyst to spark that. Retail sales almost provided that catalyst yesterday, and now it's really impacted GDP estimates. You'll see here in a little bit. You know, we might not get that catalyst until economic growth expectations really start to dial back. And we've already seen it with the estimates. It hasn't gotten really a lot of publicity, and probably won't until we get the actual advanced GDP number out, which will be due out here by the end of the month. Okay, before we look at some other charts, a reminder to subscribe to our YouTube channel. Mouse over this logo right here in the bottom right corner of your video. Click that red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That tells us two things. Number one, you got something out of the video today. Number two, it tells us that you want us to keep doing these videos. Quick, easy way to give us feedback. You can do that right now. It also tells YouTube that you think this is a really good piece of content. YouTube looks for engagements. It even looks for thumbs downs. So, you know, the worst thing, if you don't like our video, as I said before, the worst thing you can do is actually don't click on anything. Because then YouTube sees not a very engaging piece of content. They won't promote it in that case. Also, comment down below on anything that does stand out to you. What did you get out of tonight's video? Any comment, any chart, anything that stood out to you? Comment on that down below. Follow me on Twitter for more content like this in between videos. Join our Market Outlook community that we've created on Facebook. Also, join our daily Market Outlook email list. You'll get updated lists. In fact, today's list will include not only the market forecast overbought and oversold clusters in the S&P 500 on the daily charts, but will also include 2 more watch lists for the weekly charts as well. So make sure you're signing up to get those daily emails that we send out. Okay, while you're watching this video here on our blog, remember you can comment in our Market Outlook forums on marketscholars.com, right with this link right above the video. You have to join our site to do that. You can do that for free over here. Subscribe to marketscholars.com. Our calendar, a reminder that Monday is President's Day, so no classes scheduled on Monday. The market is off that day. We'll be back to our normal schedule on Tuesday with Brandon's dividend growth investing class, very, very popular, and then my directional option strategies class. Remember, also click this little heart. We got over 100, so that's great. There on today's Market Outlook tweet. Click that heart and then like the tweet. Also click this image that will take you to your Facebook account. You can like it there too. Remember, same thing, the more you click on those, the more you're telling Twitter and Facebook that they should promote this content, that they should push our content to you, all of our content that we put out there, to make sure you see all of our stuff. Alright, now let's take a look at the long-term charts here. Back to the charts, and you can see, look at this week. Look at the last, 1, 2, 3, 4, 5, 6, 7, 8 weeks in a row where we've come off that Christmas Eve low point and just rallied like a rocket ship from a low point of 23.50, 23.45 up to 27.75. Big time move in such a short amount of time. Not quite getting that golden cross yet on the 1040, and we're trading right at that 200-day moving average, a little bit above it actually. So we're not quite through and starting this new trend yet, but man, we're getting really close. As I showed before, the long-term trend strength indicators still are showing that we're in this noisy pattern. Keep in mind that, yes, this has been a big rally up through Fibonacci retracement levels, but we also had a pretty steep decline here, and we've had some ups and downs, for the past year plus. In fact, really over the past year plus, we're really not much of anywhere. From the week of January the 8th to now, we're right about 10 points away. So throughout all that volatility, for over a year and a month plus, we're essentially flat, which is why we're seeing a lot of noise on these trend quality indicators down below. Let's take a quick look at the 3 green arrows. And you notice we got 3 green arrows again after getting our little brief red arrow on the MACD. And the reason why is that MACD is really high. So it's hard for the MACD to get too much higher. The moving averages are catching up at a faster pace, and price can continue to move. The price has been going at a really unsustainably high pace. It can do this kind of a move. It just can't do it over an extended period of time. It slows down because you just run out of the same amount of buyers that you had that produced off this low point, this really good buying opportunity. We are above the moving averages on both of them, but we're getting a lot closer. You notice, if I were to take a look at the MACD, if I were to take a look at the MACD here of current levels compared to the 30-day moving average, 30-day simple moving average, you can see that we're starting to pull back here. We're also at high levels, a little bit of a head and shoulders pattern, but we're getting weaker. The moving average is catching up at a faster pace now than what price is moving, and that's very typical, right? We'll kind of grind our way down as this slows down into this resistance area, where we do have some resistance in this area, some volume resistance from the top end of this volume channel. 70% of this last 52 weeks volume has occurred in this area, with 280.5 being the upper end of that area. Alright, now let's take a look at the intraday charts. You can see we finished right at the high of the week, and right at the high of the last, we pretty much finished at the high of the last 4 weeks, and the beginning, the low of the 4 weeks was pretty much right at the open. You cannot have, I don't think you can have, I think that low is right at the opening period. I think the high is right at the closing period of the whole 4 weeks. So quite the disparity here of about, what, 18 points. So not 10%. 10% would be 27, obviously, and not, we're still above 5%. 5% being what, about 14 or so. So, above 4%, but, again, this will move up a little bit here after today, and after a couple more days, we'll move up into this area, which will start, and this line will move up to the Heikin-Ashi candle. In fact, we can kind of get an idea already of where it will move up to. If you look at we have to go to SPY here, and then change our style to Heikin-Ashi. And again, it's just the open and the close of this candle. The open at 267.11, the close at 274. So 267.11 minus 264 divided by 2, and add that on. Right? Is those numbers right? 267.11 and 274. There we go. So that puts our open at 270.5. So this will be here. We'll edit that and put this at 270.5. Is that right? 270.5. Yep. So we'll hit OK on there. So there's going to be next week's opening price, and obviously there will still be a relatively large body because we'll open up probably around here, and that's how far it can drop, but still, give us a good bullish Heikin-Ashi candle for next week. The low point for next week will be right about in the same area as the purple line, because that point right there will be this week's low point. So the brown line, the brown low, will move up there, and this will gradually move up higher too, but not a whole lot next week, because by the end of the week, we'll be looking at a low point probably like in this area, right in here, from here up to and here. So we'll move up about maybe 2 points. So this dotted line will move up less than a point. So we're looking at 269 3/4. So we'll be in this area. All three lines will be right here in this area next week, which is a little bit above 270, and we're at 277. So even if we pull back next week, we can pull back towards 7 points and still just be nothing, right? That will be not a big deal at all, because we'll easily be in the upper half of the range. We'll easily avoid a lower shadow on the Heikin-Ashi candle, and we'll easily stay up above and won't form a lower low on the weekly chart. Of course, we did get a higher high and a higher low with the gap. Very small range, but you have to account for the gap there when you're accounting for the range. So we'll go to SPY. You can see the range is only at 1/3 points, a little more than 1 1/4. But remember also, you have the close at 274.38. The low here at 276.13, so you had about 1.5 points of gap. So you're looking at about 2.5 points, maybe up to 3 in that range. So almost average. The exact number here. Let's look at the exact number, since it's Friday and I'm not doing very good here at guesstimating. So the low today and yesterday's close. So add that on to today's range. So our range today, including the overnight trading, was 3 points. So just under the average of 3.33. You see the volume was actually just above the average. So when you look at the grind of 97 million, so a little bit above average, but not very much. 3 points, a little bit below average. So not nearly as low as we've been. The ATR, the relative ATR, hasn't crossed below that 1% level, which is another sign that the trend has taken hold. And then, of course, the other sign would be volatility breaking below 90%. Just can't do that yet. So we'll see if that is able to break through next week or bounce. The expectation is that it would bounce, right? That's, again, because of how bullish we've been, and we're coming out of options expiration, which is acting like a magnet, pushing us up higher today. We did close a smidgen below 15 on volatility, and we'll see what happens. A good solid close, now we're talking, right? A good solid break below that ATR level, and now we're talking that this long-term trend has taken hold, and we can just start to grind, because that's what trends do. They just grind higher with small moves. I don't think we're necessarily to that point. We actually might go up a little bit more towards 280, because I think we'll get a little sucker move, like a sucker breakout above 280 to sucker some people in, thinking now that we are above these highs, we're set to go. And especially on that Bollinger Band too, because everybody knows that's where the resistance is going to be in that 280 area. So I wouldn't be surprised if like Monday or Tuesday we get a really decent move to the upside, but then can't hold it. And that's probably how, from a technical perspective, the pullback will start. So whether that occurs Monday or Tuesday or Wednesday, who knows? But because we can still get a couple smaller days as we approach 280. But I think that kind of sucker like this one here where we kind of suckered our way up above 280 thinking, okay, we're going to do this, and then in a couple days we're right back down below it. Same thing here. We got above 280, looking good or really close. We did get above on an intraday basis above 280. Weren't able to hold it. You know, I don't think it'll be that stark because we're not in a bearish trend right now, but that's the kind of thing. A sucker move up above 280 and unable to hold it will probably start some kind of intermediate pullback. Alright, so before we start taking a look at what's driving this price action and what we should expect to see next week, what do you think so far about the outlook from that technical perspective? Do you agree with that or disagree with that? Hit that poll popping out in the top right corner of your screen and either hit agree or disagree. If you click disagree, as always, scroll down to the bottom, comment down below on what you see that would suggest something different. Maybe we're full sail ahead, or maybe you think that there's more of a pullback coming than even what I'm suggesting. So either way, if you see something that would disagree with what we've come up with here, let us know. Share with the community down below in the comment section. Alright, let's take a quick look at what's the driving price action this week. This is the chart for the week, and you can see crude oil, you know, it was a kind of a stealth influence on the bearish move in November, December. Now it's getting some stealth strength with a 6% move higher. Remember, if I were to customize this time frame all the way out to that Christmas Eve low point here, here we go. Well, actually, it started. Let's go to the the next day here when we opened up the next day, and then go to a daily chart, because we actually did go down a little bit lower the next day. You can see a little bit lower, but you can also see too. Actually, you know what? Let's go back to Christmas Eve. There we go. So Christmas Eve finished down, and you can see the rally since then. But it doesn't get the intraday low on the 26th. So you can see since then, since that low on Christmas Eve, look at crude oil up 22%. So it was the biggest decliner during the pullback. It's the biggest move higher on the bounce. You can see small caps really taking off. There was a lot of weakness in small caps even before the market peaked in October. The broad market peaked, and it's taken off 22% plus versus the 15% gain in the S&P from the close. Remember, there was an intraday low on the 26th that adds to that return. You can see developed markets have had a good week this week, outpacing emerging markets, which have kind of flattened out. You can also see down here at the bottom, agricultural commodities are down, but so is the dollar. Dollar's down, long-term bonds are down, foreign bonds are down, all your safe haven. Gold has been rallying. It's been flat lately, but it's had a decent move off that low point. High yield outpacing treasuries. High yield didn't drop nearly as much during the decline, which was a sign that maybe we were dropping way too much. So you can see it's bouncing back up, but not as much as preferred stocks, which is what you would like to see in a risk-on scenario. So pretty risk-on chart, aside from some relative weakness in emerging markets here over the last couple of weeks. Some pretty decent moves that we're seeing. You can see U.S. really from that peak here. What would this be on September the 5th? U.S. stocks are actually higher. Emerging markets are a lot higher. Or excuse me, small caps. But emerging markets are down. So even developed markets are a little bit higher than the peak on the 5th, but emerging markets are not. They're way down here. So a little bit of weakness creeping in. It's interesting that, you know, a lot of this chatter here today was on the resolution of the trade resolution, right, with China. Usually the positive news in China over any trade deals has been a lift for Chinese stocks. But that wasn't the case. Today it wasn't China that rallied. It was here we go. It was the European stocks that rallied big time today. You can see Germany was up 2%. If I were to change this list over here, Germany, you can see up 2%. Spain was up 2%. Italy, so these are your two emerging markets, so to speak, in Europe. There's France outpacing too. Australia, Sweden, Switzerland, Canada, UK, Japan. These are all developed. Not a single emerging market aside from Italy and Spain, even though technically they're still developed economies. They just have very similar characteristics. They're a lot higher beta Then there is the Netherlands as well. And then finally, Mexico is your best emerging market performer, with Russia, Taiwan, India down at the bottom with China. So China didn't get a lift today. And if this is all, if today's rally has been all trade war influenced, then you would have seen China up here too, and it's not. So a little interesting to see. In fact, China's getting some long upper shadows here on its long-term chart. We might be seeing some weakness in this emerging markets. Last week's getting the long upper shadow. Just temporary. I don't expect it to last too long because, again, it's all a function of what the dollar's doing. The dollar, a little bit of a long upper shadow itself this week on the dollar. It has had a strong bounce the last couple of weeks, hence the weakness, relative weakness in emerging markets. The question is, how much longer that bounce can last, or whether or not this is going to turn into a head and shoulders pattern for the dollar. You can see gold futures, a little bit of a hammer or a hanging man pattern here today. We'll see, what that turns into from a risk appetite standpoint. Because remember, usually risk appetite, this will be an underperformer, gold would. But again, a function of what the dollar's doing. The long-term bonds had a bounce back, but not necessarily. Here, let's look at the 10-year yield. Long-term bonds had kind of stopped the bleeding, but you see how the yields are still in a decline. And again, that's a function of rate hike expectation, which are for this whole year is still very, very low. Still 3% is nothing, right? And they're still very low odds of a rate cut. But if you notice, the economic indicators with that retail sales number coming out yesterday, look at the drop on the GDP estimate, almost in half, from almost 3% down to 1.5% with that retail sales. If you take a look, today's big numbers were the Empire State Manufacturing Survey, which had been low, bouncing up a little bit, but still relatively low there, but not negative. That's recessionary when it gets negative, so we're not there, fortunately. Import and export prices, another inflation indicator, aside from the CPI and PPI, look how they both have gone negative on a year-over-year basis. That's significant. You can see the last time we were negative in this global recession time frame, or coming out of the global recession time frame in 2015 and early 16. So significant to see those two go negative. And of course, industrial production, another important technical indicator. Again, you can see which has been very, very bullish, but the year-over-year figure has been declining. With a pretty relatively large negative month-over-month figure, and then finally consumer sentiment. This is the advanced figure, the preliminary figure for the University of Michigan at 95. So a nice little bounce back up in consumer confidence from the University of Michigan. So all that said, that sharp drop in retail sales, look at what it did to the economic surprise index. Dropped significantly down to minus 23.6. Now remember, there's a lot of indicators that haven't been released, and that number was late, but still that's a significant drop and puts it more on par with the lows of last year, and that's going to impact interest, and this too will impact interest rate hike expectations and keep them down. As long as they're down, you'll see yields continue to go down. That will be bullish for bonds, not necessarily bearish for stocks. It could be bullish for stocks too, especially for international stocks. It could provide that lift for all stocks, including the S&P 500 and other U.S. areas. So with crude oil having the best performance among asset classes, you can not surprisingly see energy having the best performance on the week from a sector rotation standpoint. So XLE has been such a underperformer. It's starting to move its way up the ranks, right? It's, if I were to go back, let's say even just like 6 months, look at how energy up through that 6 month, up through that December low point was such a weak performer, along with materials, along with financials, and energy bouncing up quite a bit off of that low. In fact, if you go back to and take a look at, again, off the Christmas Eve low point on the daily chart, energy now with this week's move has passed technology and consumer discretionary. It hasn't caught up yet to industrials, but those two areas which have been so bearish, materials still lagging behind. This is fluorescent green, still lagging behind along with healthcare and real estate and other safe haven areas. So it hasn't really caught up, but energy has. So great move on energy along with these other cyclical areas that are still pushing our way higher. Utilities, staples, real estate actually doing pretty well too, catching up to the broad market. These other safe haven areas, interest rate sensitive areas, staying behind despite the drop in interest rates. In fact, if I go back to October the 3rd, the peak in the market, and you can see from low to high, we're still not back to those October 3rd highs. And you can see that real estate is still, I mean, it's from that October high point when the market peaked. The broad market itself is still down 5%, but real estate's up 8.5%. Utilities is up 5%. Staples is flat. So those areas which held their value much better during declines aren't going up nearly as much, especially utilities and staples, but they're still going up enough to maintain some outperformance against these cyclical areas which drop the most, especially energy. You can see energy, because it dropped so much, and it's had a great run to get to this point. It's still down 14% from those October highs. It's still got quite a ways to go. If I were to look at the sector rotation standpoint here and just pull these out here, in fact, let's do this. Let's go here to weekly charts and all of these. So here are some of the top performers as of the last sector selector update, which we'll get a new one here, as we usually do every weekend. This is the sector selector, is that proprietary tool that Brandon puts out on our blog at marketscholars.com. So you can see how like materials still hasn't caught up, energy still hasn't caught up, staples is just barely passing, discretionary is barely passing. You can see industrials is taken off. Look at utilities and look at real estate. The real estate's at 3-year high points. Utilities is close to its 3-year highs. Technology is caught up, similar to the broad market as a whole. Here's the broad market. And healthcare and industrial is kind of looking better, whereas and materials and energy still lagging, and discretionary communication services here, which we don't have nearly as much time frame here, but communication services, and here, let's see if we can go back just 1 year on a weekly chart. Yeah, so it still doesn't have as much, but you can see we're not back up. It looks very similar to what we're seeing in technology and discretionary. So the areas to be are still these safety areas until some of these other areas catch up and pass through some of these important resistance levels, technology, discretionary. But then eventually, if the dollar remains weak, energy and materials will start to catch their way up towards the top as well. One stock in particular that's been really beaten up, Nvidia here, in that cyclical space, had an earnings announcement here, and you can see today's, after the market yesterday, and today's response was some strong volume, 3 green arrows, rising trend, but significant from a volume standpoint. You can see that we kind of broke, and we had this volume node that we were basically triangling in. Then with this move, got us into into the range, right? The 70% of this year's range has been over here, and because this drop was so quickly, you can see there's not very much volume in between. So there's an opportunity for a good trend up to 245 if this were to take off and move to the upside with this 3 green arrows. Of course, if it doesn't, then we'll know, right? We're pretty darn close to the lows, so we can keep our risk small and give ourselves the opportunity for it to make that move up to the upside. If you take a look at some of these other indicators after today's move, the positive DMI getting above 25 with that volume. If I take a look here at the other, here we go. The other indicators, you can see positive on the oscillator as well as on the DMI stochastic extreme. I did a class on those 2 indicators in my technical analysis class. You can check that out there. So there's opportunity here. If I take a look at the long-term chart on Nvidia, you can see that decline that we've had. I mean, look at that. We're so far below. In fact, the 50-day moving average is so far below the 200-day moving average. That, I mean, this is the first time in years that we've been this far below, and we've had such an extended move. There's opportunity for it to get back up into this area around where the 200-day moving average is. That gap is easily fillable. You know, you got some resistance here. You got resistance at the blue line, but the gap in between, especially the bigger it is, it's easier to fill. So again, a nice simple trend trade, you know, nothing too fancy. We can keep our stop order below these recent low points. If you go back to the 3 green arrow chart, and see the low point that preceded the 3 green arrow signal. So we're looking back down into this area. So keep your stop, even if you go below this low where the last red arrows were, put your stop order in a couple of ATRs below that, and then let it trend. And if once we get 3 red arrows again like this, like we did here just recently, we can use that day to move our stop order up to 3% below that day's low point, if and when that occurs in the next little bit, if it does. So, and if it if it breaks down, we can, again, because the posture of the market is so extremely bullish, we don't want to use a normal position size on this. We'll start small, and as the market itself establishes the trend, you know, out of this noise that we have, then we can say, okay, now we can start to build in on the next buy signal into more of a normal position size. Alright, well, that wraps us up for tonight. Now I want to hear from you, so let's use that link up above the video to go to our Market Outlook forums on marketscholars.com. You have to subscribe for free to participate there, but you can. But I want to see your comments. I want to see any questions you have for me, any questions or comments about what I did not discuss in the video. You can throw in there as well, and be able to get feedback and discussion from other market scholars that's watching these as well. As always, thank you very much for watching. Have a great rest of your holiday weekend, everybody. Remember to subscribe to our YouTube channel, click that thumbs up icon, and comment on the video below. Follow me on Twitter for more content in between videos from day to day, and join our Market Outlook community on Facebook that we create on Facebook, as well as on marketscholars.com. Have a great one, everybody, and we'll see you all next time.